Could you give us a sense of how the markets are looking at the moment, as well as perhaps some clarity on what exactly is driving the Asian markets specifically?
Good afternoon, and thank you very much for having me. The markets are slightly down today. I think we've had quite a surprisingly strong last couple of weeks on equity markets globally. I know, from a personal perspective, I've been very bearish thinking, very disbelieving of the fact that markets are going up given the context of the sort of global economic worries and headwinds we have at the moment, particularly with sort of lockdowns around the world. However, markets are proving to be a lot more resilient than what I believe they would be. I think, largely driven by massive quantitative easing programs and stimulus packages, not only from the US, but from pretty much every central bank around the world. Now we're seeing a bit of a recovery as well in terms of demand for energy as well as manufacturing and sort of just the general Asian Pacific area coming back online, where we have China coming back online, coming out of lockdown. We saw this morning New Zealand basically putting an end to social distancing. So the coronavirus sort of induced lockdown and a slowdown of the economy is starting to abate a little bit. And as the world is kind of waking up from the slumber that it's been in for the last 2 months, we're seeing a huge surge in demand. And, you can even see that with some of the local stuff that we do. As soon as you're allowed to go back to the shop, people are queuing for kilometers around the mass mart or the macro, So I think that we probably have a bit of a resurgence in demand, and that's what is why we're seeing markets react as strongly as they have been over the last couple of weeks. Today, markets paring back a little bit. We had a very strong session on Friday, so it makes a little bit of sense that they're coming back. But if you look at the way that they traded in sort of the overnight session in Asia, it was relatively strong as well. And that I think is just back on the back of sort of the world coming online again and starting to produce and starting to consume, and the world economy coming back to some sort of level of production or productivity.
And what is the latest on the US-China tensions?
So that's a bit of a complicated question because it looked as if we had last year phase 1 of the trade deal was signed between the US and China, and all these agreements were made, and since then, obviously, the coronavirus sort of pandemic broke out, and we've seen the U.S. make some scathing allegations towards China, calling it the Chinese virus and calling China irresponsible and all sorts of stuff. And China is sort of countering with media stuff, the stuff that they're putting in the media around, 150 things that America is accusing China of that China's got wrong. So they're kind of like fact-checking, if you will, some of the things that Donald Trump is saying, right? And this is from the Chinese state media, and they're doing one fact a day kind of thing. So there's this interesting sort of disinformation thing happening between the two countries. And now what we've also seen is on the back of this escalating tension and name-calling, if you will, we've also seen Chinese companies put an end to soybean and pork purchases from the U.S., which was pretty much the cornerstone of the trade agreement, or the phase 1 trade agreement between the two countries. So the trade deal in its current form is at a risk of falling apart. There's, experts or analysts, I suppose you can call them, expect this phase 2 deal that was expected this year to not happen. And that there is a very high probability that we see even the phase 1 trade deal fall apart. So now countries like America have sort of fired the first shot and are rallying other countries, what they say are other democracies, to create, instead of a G7, have a G11, the 11 most influential countries in the world, except no China. They're also making moves to sort of create a consortium of democracies that can manufacture and produce 5G telecommunications equipment so that they're not dependent on China. So we have this real polarization between America and China. And I think that, so the latest is that tensions are heating up, and there's a lot of talk about we could have a Cold War, so not necessarily a straight-out conflict, but just this cloak and dagger, well, we won't trade with you and we'll try and sanction you in every place we can, and we're going to use our allies to stop buying stuff from you. And, U.S. companies, or the U.S. is making moves to kind of regulate, and we see that even the U.K. did it over the weekend, making rules to say, certain declarations and things that companies have to do if they are doing deals with China or have a Chinese takeover of the local company. So if you're a UK business, you have to disclose things and sort of ask for approval before a Chinese company may take over your business.
Certainly very interesting developments on that front, and the type of developments that are likely to impact the markets as well. But let's take a look at Alexandra Forbes. I mean, they've opted to distribute about 600 million rand in a special dividend to their shareholders. Take us through the rationale behind this move, especially when so many are just holding back during this time.
I think that, from the perspective, I'm not really too sure what the exact rationale is for them to be doing this. But, the truth is that if they have a little bit of money that they can distribute, then they're doing that. And I think that, part of it is that they've not had the worst sort of time in the market, in terms of earnings and stuff. They've done pretty well. But, at the same time, what companies tend to do is in difficult times, they try to defend their share price. What we see happening is these companies tend to cut dividends. For the most part, long-term investors buy shares because they give future earnings. You get this dividend that is very low taxed, and it creates sort of an income stream for you, right? And that is why investors buy shares. It's not for the share price appreciation as much as it is for the cash flow that is generated by that share in the form of dividends. So during bad times, people obviously panic and sell down shares, and this is bad for management and people who own the shares because their net asset value is pinned on the share price. And also sometimes if there are sort of lending agreements and stuff pinned to the amount, pinned to with securities, or the shares as security for lending agreements, then the share price is relatively important. So what they then would do is then pay like a special dividend in order to entice shareholders to keep the shares so that the share price is necessarily negatively affected. But, at the same time, if you look at some of the stuff in the report, income from continuing operations was up 1%. So it's not like they're shooting the lights out, but they are doing relatively well. So they've got, the company itself is doing relatively well. Headline earnings per share for the group is obviously down in recent times, but in general, the business is doing relatively well, and they feel that they have enough cash on hand to be able to pay it out, and that's what they're doing. What their motivation is, I'm not sure. I'm obviously speculating when I say that it's to defend the share price, but it's a plausible reason. It's not necessarily their rationale, but it certainly
does keep the shareholders happy in this particular instance. But before I let you go quickly, Petri, if you could just comment on RCL Foods. They released their trading statement for the year ending June of 2020. Take us through some of those numbers.
So their headline earnings per share is down around 20%, which obviously makes a bit of sense. They've been negatively impacted by the lockdown and social distancing, and basically quick service restaurants being completely shut down. And we know that they're a major supplier of chicken to some of the sort of fast food takeout places in South Africa, some of the very big brands. And they've just had obviously no sales, right? So their earnings have been sort of negatively impacted on that basis, which obviously makes quite a bit of sense. Other than that, there's not really too much else that they put out in that trading update, just basically saying, look, guys, this is the warning. Our earnings is going to be down in excess of 20%. More information to follow once we have finalized results. I guess no real surprise. I think that from a market perspective, the market is really anticipating companies to come out with really bad numbers. We've seen how in the beginning, at least a couple of months ago, a couple of weeks ago, when bad numbers came out, the market was really shocked. But at this stage, I think the market is starting to look at things and going, well, look, we know the next set of results are going to be really bad, but we're more going to focus on what's the forward guidance. What is it going to look like in 6 or 12 months from now, rather than the period that they're reporting on at this stage. And based on that, the markets will react, depending on whether or not they see value in the share price or not. So in the short term, no one's really surprised, that profit is going to be down by more than 20% or earnings is going to be down by more than 20%. That at this stage is sort of a given for almost every company, right? So not too much information in that trading update. I guess we have to wait.
I guess we'll have to wait it out and see. And as you say, just project into what the future may be looking like instead of being caught into the stark realities of the present. Thank you so much for that market update, Petri. That's Petri Redelinghuys there with today's market update.